Hey, friends. Hey, just want to come to you and talk a little bit about uh, term life insurance and index universal life insurance or universal life insurance. What is the difference? And, why should I buy or you should buy a term life policy as opposed to a permanent life insurance policy like a UL, universal life, or index universal life? And there's many reasons why people buy term policies, and one of the biggest reasons they can buy a large amount of death benefit for a small premium. When you compare that to policies like universal or index universal life, which you pay a larger premium for the same amount of death benefit, and there's a reason for that, and I'm going to explain that to you today. Um, Term life is like renting a life insurance policy, like renting your home as opposed to owning your home. Owning your home would be akin to buying a permanent life insurance policy like a UL or IUL, Index Universal Life, or Universal Life policies, or even whole life, right? So, and I'll get to that in a moment. But so, how do we look at term? Term is more of a temporary type of policy that you can have in case you want to have a large amount of coverage for a short period of time, which could be five. Well, yeah, there's some term life policies for 5 years, but usually they're 10, 15, 20, and 30-year terms. And they start the day you get approved and you pay your first premium, and they end at that term. And so the longer the term, the higher the premium, the more the life insurance death benefit that you choose, the higher the premium as well. And the other factors that are going to affect the underwriting or the price of the premium that you're going to pay is your health, your height and weight, your driving record, and your criminal record if you have one, which could get you declined completely. They don't want to insure dangerous people. Also, people that practice crazy sports like skydiving and things like that, you might get declined. So, but if you're none of those, then you should qualify for a term policy, and you can buy a 10, 15, 20, 30-year term for any given amount of money, from $50,000 or $25,000 to millions of dollars worth of it. And so anyways, you pay your premium today, and you pay it monthly or yearly or quarterly or semi-annually, and you pay that premium for the term. And if you survive the policy, all your premiums are gone, and the policy is gone. It's gone. If it goes through the whole term, then you don't have any coverage. So what happens is some people choose a 10 or 15 or 20-year period, and then they go, you know what, I really need insurance beyond that term. And so now they have to apply for a new life insurance policy. And if they have to apply, their health might not be as good as it was before. Now you're older, your rates are higher, and whether you qualify in the first place is one thing, because if you had cancer or a heart attack or a stroke, or you have been hospitalized and just barely made it through and got out of the hospital and now you're getting better, you might not qualify for a new policy. So we say in the industry that health is what buys your policy, the money only pays for it. So keep that in mind. Is I might qualify today, but maybe not tomorrow, right? If you're still alive, because if you're dead, you're dead. I had a lady tell me, "Oh, Raul, you sell life insurance. My husband just passed away a week ago. Could I still buy him a policy?" I was like, "Oh my gosh, Obamacare." Maybe they could insure you, but it wouldn't be for life, right? But anyways, yeah. So crazy things. I've seen a lot of stuff happen through my career. 17 years selling, or well, more, close to actually 21, selling life insurance policies. But anyways, yeah, your life and your health is what's going to get you approved. The money's only going to pay for it. And so get the coverage in place right now if you need it. Don't wait, 2 weeks, a month, 4 months, like, other people have. Because, some people have put it on the shelf and say, oh, yeah, I'll take care of that later. Well, you know what? Life happens. Tomorrow's a new day. Tomorrow you go to work. Then you have to pick up groceries. Then you have to pick up the kids. Now you've forgotten about the life insurance coverage and it never gets done. So then, illness comes or death comes. And then what happens to your family? What happens to your family? How are they going to replace your income? So, that's a big deal. And I've had it happen. I've seen, people die without life insurance. When we talked about life insurance, and I said, you need to take care of this. And, to a friend of mine passed away without any life insurance coverage. And I told him that if he died, his family's going to be at odds financially. And it happened. He passed away, and I got a call from the widow. And the widow called me and said, he was gone. And she wanted to ask me if there was a life insurance policy in place that I had done for him. And I had to tell her no. That was heartbreaking because she ended up losing the home, and they've gone through a lot of just financial troubles because of that, because he was making a good amount of money. So, anyways, let's go into universal life and index universal life. You pay a higher premium, but part of that premium goes into a cash account. That cash account is like a bank account almost, where you're going to get an interest rate credited to that balance. The other part of the premium pays for the risk of having you insured for X amount of dollars. So, so the part that you accumulate in your cash account could earn anywhere from 4.5 to 6.8% per year, and depending on the product and depending on the company, and that money accumulates. You build up a cash account in 3, 4, 5, 10, 15, 20, 25 years that you've had the policy. The more time you have it, the more time it has to compound and earn interest and grow. And after you've had that policy and you've been paying your premium for 10, 15, and 20 years, you have a sizable amount of money that you can use for your own bank, which means you don't have to go to the bank to get a loan to buy a car, or put a down payment on a house, or whatever that may be. So people have borrowed. I had a client that just borrowed $200,000 of cash value from her life insurance policy, and the time that she had that money, she used it to pay off a home that she just bought, and then she replaced the money, put it back, but she paid herself the interest. The money that was borrowed, the cash balance never lost that money. It just kept compounding with more interest rates. And when she returned the money back, now she had the interest that she had earned in the cash value account plus the interest that she paid herself. So, this is what you do when you have your own bank, is you borrow from yourself, from your universal life or index universal life policy. And a lot of people use that money also for retirement. When they're in there for 15 or 20 years, then people say, hey, Raul, I want a pension from that money. How much money do I have in there right now? Well, we look up the balances, and some people have 150,000, 175, 250,000, $400,000, and they say, how much money can I get paid every year from that balance for the rest of my life without depleting the account? I want to make sure that I don't outlive my money. And we make the calculations, and people get a pension from it, 40,000 a year, 50,000 a year, and this is tax-free money. So they don't owe a cent from that, as opposed to your 401k, right? Your 401k, you draw money out, you're gonna be paying the bank. You're gonna be paying, well, not the bank, I'm sorry. You're gonna be paying the government the taxes on those withdrawals from the 401k. and that's ordinary income. Okay. And so ordinary income tax rates go up, which we think they will, then you're going to pay a high tax rate on your 401k withdrawals. That's a problem because, you could be paying right now 10, 15, 20, 25, 30%. But, 5 years from now, what could it be? The government's going to make a decision on that. How much money are they going to tax you on your ordinary income? Could it be 30, 40, 50, 60%? Do you trust the government to do the right thing for you? Well, imagine paying 50% taxes on withdrawals from your 401k. So if you're drawing out 50,000 a year, 25,000 could go to the government. So you end up with $25,000 net on your 401k. So why not put something in place where you can avoid these taxes, like a universal life policy? So anyways, I don't want to complicate the matter anymore. I hope that, it's been clear. If you have questions, call me, contact me, go to my website. It's heavierretirementplans.com. And let me go there and show you my website. I have MetLife, who is a great company, but they're not cheap. But I represent 30 different companies. So www.heavierretirementplans.com. And here it is. And so I have a lot of information about what I've just talked about. But, you can contact me through WhatsApp right here. You can contact me with, calling my cell phone number. You can send me an email. You could book an appointment and have a consultation. It's all free. And, you can read more about or watch some videos about what we've talked about here and more. So anyways, go visit my website and give me a ring. I'll be happy to answer any questions, give you a free consultation and see what your goals are, what you need, and I'll help you. All right, my friends, take care. Be good. Live life free from the government.